Hi, and welcome back to the Business Career College video series. In this set of videos, we're going to look at health and dental insurance. Now, we're pretty fortunate in Canada as far as our health and dental expenses go, in that it is fairly unusual for somebody to end up with a very large bill for their health expenses. Generally speaking, if I go into the hospital for something that's medically necessary, then I'm going to walk out with no bill at all, or potentially a small bill for things like use of a private or semi-private room or parking or something like that, but relatively inexpensive. Now, this is sometimes also referred to as major medical insurance. You'll sometimes see the term major medical or extended health care as well. So lots of different names for what's really the same thing here. So this variety of programs, our major medical, health and dental, extended health care, whatever, is really designed to fill the gaps that exist in our provincial health care plans. So whatever province you're in, you have a provincial health care plan where your government provides your basic level of health care for services that are deemed to be medically necessary. So you know that you're going to get medically necessary services covered. That's generally things related to a stay in the hospital, some surprising things that aren't necessarily covered. One of the things that's often a shock the first time you have to pay for it yourself is, for example, getting to the hospital in an ambulance is not generally covered under a provincial health care plan. You might end up with, as I mentioned, a bill for a semi-private or private room while you're in the hospital, so you want some enhanced services. Semi-private or private accommodations are a good example of something you're going to pay for. Prosthetics are generally not covered, and that includes all sorts of assistive devices that may not be covered. Um, if you want, generally a very basic type of artificial limb would be covered, but then things like nicer artificial limbs or hearing aids or the like are not necessarily going to be covered. In some provinces, diabetic supplies may not be covered. Unless you get them very specifically in the hospital as part of a regular treatment regime, your prescription drugs are not going to be covered. And we could go on with the list. There's all kinds of things. Most of your paramedical services and your paramedical services include things like massage or your chiropractics, holistic medicine, that whole range of stuff. And then, of course, most vision care is not covered. There are exceptions for children and for seniors, but for the most part, vision care is not covered, and most dental care is not covered either. Now, there is a range of other services that are excluded generally from your provincial plan. Cosmetic surgery is generally not covered unless it's medically necessary, and elective procedures are also generally not covered. And I should mention that not all Canadians necessarily receive coverage under provincial health care plan. There are some people who receive coverage under federal health care. Generally speaking, that applies to status Indians as well as members of the armed forces and the RCMP. They'll get service from the federal government. So we have these services that may not be covered. Well, what you might want to do then is you might want to put in place some insurance to cover this off. Now, if you know how insurance works, you probably recognize that an insurance company is in business to make money. So here's what you might have. If we have somebody for whom we have expected claims, so let's say that we have a person or a family where we expect claims in the neighborhood of, let's say, $1,400, the insurer says, well, we need to make some money at that. In order to make some money at that, we're probably going to charge premiums in the neighborhood of, let's say, $2,000. Okay, just for the sake of argument, this would mean, incidentally, and you see this in group insurance, not so much in individual insurance, but $1,400 out of $2,000 is 70%. That's a 70% utilization that the insurer is expecting, or in group insurance, you'll see this term, a 70% target loss ratio. So this begs the question then, why would somebody do this? Why would I pay a premium of $2,000 to get services that I expect are only going to be in that $1,400 range? Well, there are several reasons why I might. And one is because I might be concerned about catastrophic claims. So while we expect claims to be in the $1,400 range, when you look at, how about prescription drugs are a good example of a place where you can have very large claims. There's a commonly prescribed medication today, a biological drug prescribed for rheumatoid arthritis or for Crohn's disease, among other conditions, called Remicade, and Remicade can run up to $20,000 per treatment. Another reason that you might be willing to pay this difference is there are some substantial tax advantages to doing this. And your tax advantages come from the fact that as a self-employed person, these premiums would be tax deductible. That is, if you're self-employed or you own your own business, and then any money you receive as a reimbursement for health expenses would be tax-free. So that can end up being a substantial advantage. There is a third reason, and it might be that you prefer to spread your health expenses evenly over a period of time. That is, this can be effective for budgeting purposes. Now, this leads to some questions as well. That is, from the insurer's perspective now, they want you to buy this policy. They want you to spend this money. They want you to have coverage that is attractive enough to keep paying premiums, but they also want you to, in a typical year, have claims that don't exceed that $1,400 limit. So this is where insurers put some limits in place or some controls to make sure that you're not going to go beyond that $1,400. So some examples of some of these limits or controls come about first off with some cost sharing methods. And cost sharing are really methods by which the insurer says, okay, we'll pay a portion of that cost, but we're going to pass on a portion to you as well. And that portion might come about in the form of a deductible. And a deductible is a dollar amount, such as $25 or $50 or $100, and it's normally reset annually or sometimes every second year with certain types of benefits. We can also have coinsurance. And what coinsurance does is it says, okay, for every claim you submit, there's going to be a limit here. So, for example, the insurer might pay 80% of every claim, which might also be expressed as a 20% copay, meaning that you're paying 20% of every claim, or you could have a 90% coinsurance, which would then mean a 10% copay. So the next set of limits or controls we put in place come about where the insurer says, okay, here's what we're actually going to cover. So they will have maximums of some sort. And these maximums can come a number of different ways. So, for example, we might have recalls. This is common with dental and sometimes with paramedical services as well. And here you would say you can get one cleaning per family member every, say, 9 months. That would be a 9-month recall. We have a fee guide associated with dental expenses, which says these are the expenses that are reasonable and customary for that particular type of dental work. If you choose to go to a dentist who charges you more than that, we'll still cover it, but we'll only cover it up to that fee guide limit. With prescription drugs, we have what's called a formulary. And a formulary is an agreed upon list of prescribed drugs that will be covered. So a list of covered drugs here falls under a formulary. And we might have a time limit or a minimum amount of premiums that have to be paid. So for example, you might have to pay 2 years of premiums before you have ortho coverage, before you can get any orthodontic coverage. Speaking of ortho coverage, it's very common to see a limit here, and it might be an annual limit, or it might be a lifetime limit. Again, if ortho's even covered under your plan, it's very common to see this kind of thing, where you might have maybe no more than $1,500 of ortho coverage for 1 year, and maybe a total maximum of $2,500 of ortho coverage for the entire lifetime of the plan. So insurers apply these limits to a number of different services, to pretty much everything that's offered in a health and dental plan, actually. And by doing this, they're going to keep those claims down to a manageable level. I hope this helps you to understand how health and dental insurance works. It really is going to come down to which of these benefits do I need. It doesn't make sense for everybody to purchase health and dental insurance, but it certainly does help, especially in the instance of a catastrophic claim. And as mentioned, a self-employed person can benefit substantially from the tax advantages. Thank you very much. We will be covering the coordination of benefits in a separate video. Hi, and welcome back to the Business Career College video series. In this video, we're going to look at cost sharing with respect to health and dental insurance. So we've seen in previous videos that insurers are going to look to share the costs with the plan member. And there are some reasons for this. The first is, the idea here is to create some impetus for the plan member to actually think about what they are submitting in terms of claims. That is, if they know that they're going to have to pay a chunk of every claim, maybe they think twice about whether the procedure that they're getting or the prescription that they are getting filled is actually necessary. And the second is simply to reduce the insurance company's costs, which in theory should keep premiums manageable. So to see how cost sharing works, we're going to look at a plan member. We're going to look at Paul. And Paul has some benefits. They might come from an individual plan or from a group plan. Either one might have a structure like this, where we will have some deductibles. And there are a few different ways deductibles can apply, but for the purpose of the LLQP, the way that you would normally see them is you would see an individual deductible. That doesn't mean for Paul as an individual. That means for each individual covered under Paul's plan. So let's say we have an individual deductible of $25 and a family deductible of $75. That family deductible would be a cumulative maximum deductible that could apply across all family members. And then we'll give Paul a co-insurance factor of 80%. Okay, now let's say under Paul's plan that we have 3 family members. We have Paul, his spouse Patty, and their 3 children, Aaron, Jessica, and Stephen. And Aaron is 8 years old, and Jessica is 6 years old, and Stephen is 3 years old. Okay, so we've got the 3 family members. So what would happen here is, let's say throughout the year, Paul goes to the dentist first. So Paul's the first one to the dentist for the year. He would have a $25 deductible. And then Patty, later in the same year, also goes to the dentist. She would also have a $25 deductible. And then Aaron goes to the dentist, and Aaron would also have a $25 deductible against any expenses incurred here. But at that point, we have actually applied 3 individual deductibles of $25 each. That is going to bring us to the $75 family deductible limit, which means that now if Jessica goes to the dentist, she would have no deductible because we have hit the $75 deductible. And then finally, Stephen would have no deductible if he should go to the dentist after the others. So let's have a look at how the dollar amounts would actually work here. Let's say that Paul submits a claim. We'll say it's a new year here, so new deductibles. And he submits a claim for $360. So the first thing you'll find is that it's not necessarily going to be fully covered, this claim. We have to look at what is eligible. That is, the insurer will compare this to their fee guide, which defines what is a reasonable and customary expense. They might say, no, in fact, we only cover $320 for that particular service. That's all that's eligible. So you're not going to get the $360 covered. We're only going to use $320 as the basis for our claim. So now what will happen is we will first take off the deductible, the $25 deductible, which brings us down to $295. And we would then apply the coinsurance, an 80% coinsurance factor. In this case, and we can see then that the insurer will cover 80% of $295, which is $236. That will be the eligible claim. That is the amount of reimbursement that Paul will receive for that $320 expense. Okay. We're going to also look at coordination of benefits in a separate video, but it's important to understand this basic bit of math first. Thanks very much. I hope that helps. Hi, and welcome back to the Business Career College video series. In this video, we are going to have a look at a concept that causes some students some difficulty, and this is the coordination of benefits. Now, there are a lot of sort of other issues with coordination of benefits before we get into the heart of the matter. First off, just the idea of coordination of benefits. First off, this happens anytime we have more than one coverage that might apply to a particular situation. So we don't typically have any coordination of benefits with life insurance, but with disability insurance, for example, coordination of benefits is a concern. And with disability insurance, generally, we go in the order of payor. So for the most part, Canada Pension Plan would be first payor against any other benefit, and then Canada Pension Plan. After Canada Pension Plan, comes WCB. So WCB in this case would look to Canada Pension Plan and would say, hey, if Canada Pension Plan is paying anything, then that reduces what we have to pay. And then typically we would graduate to EI. So you're not going to have EI and CPP disability benefits paid at the same time. The benefit period for EI is no more than 15 weeks after a 2-week elimination period. CPP doesn't start until the 4th month, so those two typically won't pay at the same time. But EI would look to WCB and say, hey, if you're getting WCB benefits, you don't need to worry about EI then. And then you could have an auto policy. Auto policies pay fairly limited benefits, but in some cases they do provide some disability benefits, typically up to 2 years for a fairly limited amount if you are a driver, passenger, or pedestrian in an auto accident. And then typically we look to your group disability benefits. So your group benefits would look to your auto benefits and say, oh, you're getting some auto benefits. Okay, we don't need to pay then. Or we would look to your WCB. We'd say, oh, okay, you're getting WCB, don't need to worry about that. EI actually considers group to be first payor, so it's not a perfect picture this way, but generally group is looking to the other benefits. Just EI considers group to be first payor, and then you would have your individual disability benefits, which are generally the last payor. So this is coordination of benefits with disability insurance. It just shows that we're coordinating benefits. It means that these entities all have contractual provisions or program provisions that prevent you from collecting too much benefit at one time. There is no coordination of benefits with, for example, life insurance or CI, or with LTC. For the most part, that's true as well. We do have coordination of benefits, however, with health and dental. And this works a number of ways. For exam purposes, generally what you're going to be tested on here is a math concept. And this is where we get into the Canadian Life and Health Insurance Association's Coordination of Benefits Guidelines. So the Canadian Life and Health Insurance Association has a COB guideline that they publish that tells insurance companies what happens when we have more than one payer that might have to pay benefits. Now, this is pretty obvious in most cases. So if we have a married couple here, we have Paul, and fix that there. Sorry about that. Paul and Patty, and they have. We'll just give them one child here, Aaron, one child, and Paul has benefits through maybe an individual health and dental plan or maybe group. It doesn't really matter. And let's say he has a $25 deductible and 80% co-insurance. And Paul was born on the 20th of May of 1978. And Patty has a $60 deductible and 90% co-insurance. And she was born on the 15th of February of 1980. Okay, and they have a daughter here, Erin. Erin is 8 years old. Okay, if Paul goes to the dentist or whatever the service happens to be to get work done, Paul's plan will be first payor. If Patty goes to get work done, Patty's plan will be first payor. That probably doesn't bear explaining. The question that arises is, what if Aaron goes? So let's say Aaron goes to the dentist and gets a cleaning, and let's say that cleaning costs $340, and in this province the insurer says, okay, it's reasonable and customary, that is, there's a fee guide or some similar provision, and it says the reasonable and customary expense here for a cleaning for an 8-year-old child would be, let's go with $300. Okay, so now we have to figure out which plan is going to be first payor. So in this case, the first payor will be between Paul and Patty, a married couple or common law couple, the one that celebrates their birthday earlier in the year. That is, we don't care in what year they were born, that's never relevant. What we care about is who celebrates their birthday first. In this case, we can see that it's Patty. February comes before May. So Patty's insurance company is going to assume first payer status. If they both had the same birthday, then we would go to the first letter of the first name. So we would say, okay, that's $300, and Patty's insurance company applies a $60 deductible. That knocks us down to $240. We've got 90% co-insurance. Patty's insurer, in this case, will pay $216. Now, that means that what's out of pocket here, or what's not paid out of the eligible expense by Patty's insurer, is the $300 eligible minus the $216 they would pay. We can see then that is $84 that goes unpaid here. Okay, so that $84 amount is not paid by Patty's insurer. Let's clean that up a little bit for you there. Sorry, we want that to be perfectly clear. $84. Okay, so then we go to our secondary carrier. And in this case, our secondary carrier is obviously going to be Paul's plan. And Paul's plan says, okay, the eligible expense is $300. And now we would take the deductible off. Paul's deductible, $25, brings us to $275 times 80%. That's going to be $220 that Paul's insurance company would pay. 80% of 275 is 220. So Paul's insurer says, okay, we would pay 220. Well, hang on a second here. If Paul's insurer pays 220 and Patty's insurer pays 216, $216 plus $220 is $436. That's more than the original amount that they paid at the dentist. So that doesn't make any sense. They're not going to do that. The actual coordination of benefits guidelines say they will pay the least of the difference that Patty's plan left unpaid, or the amount that Paul's plan would have paid anyways. In this case, we can see that Paul's plan would pay $84. It would not pay the $220 we see here. So the end result is that Patty's plan pays the $216 that we calculated, and Paul's plan pays the $84 that we calculated over here. There are other possible methods of calculating coordination of benefits. However, this is what you'll be expected to do for the purpose of the Life License Qualification Program exams. And this is what is laid out in the CLHIA Coordination of Benefits Guidelines. I hope that helps. Thanks very much, and please let me know if you have any questions.
Hi, and welcome back to the Business Career College video series. In this video, we're going to look at the medical expense tax credit. And not like we have to know every single tax credit and how they're going to work, but the medical expense tax credit in particular has some applications to financial planning, to health and dental insurance that we do have to be aware of. So the medical expense tax credit, is a tax credit then. So just a quick reminder on how credits work. You would have your income, and we're going to figure out all the tax on your income, and then we're going to take off, we would figure out the total amount of income, and then we would take off your deductions. And there's two types of deductions. We're not going to worry about that too much. Ultimately, we're going to land at your taxable income. And to your taxable income, that's when we're going to apply our tax rates. So you would apply tax rates here, and there are other videos covering this. You would apply a 15% federal tax rate on the first roughly $45,000 of income, and then 22%, and then 26%, and then if your income is over about $140,000, you would apply a 29% tax rate, plus whatever the appropriate provincial rates are. So generally the lowest tax rate is going to be somewhere between 15% federal plus another, we'll call it 5 to 11% provincial, in that vicinity. Your lowest tax rate then, depending on the province you're in, is going to be somewhere in the range of 20 to about 26%. Now, why do we care about that? Well, once we calculate out all the taxation on your taxable income, then we apply credits. And most credits, including the medical expense tax credit, are applied at that lowest tax rate. So, for example, if you're a resident of BC, then you would apply a 15% federal credit plus a 5.06% provincial credit for a total of 21.06%. So if you had a $1,000 tax credit in British Columbia at a 21.06% tax credit rate, that would result in $210.60 of tax savings. We would reduce your tax bill by $210.60. And it doesn't matter for the purpose of most tax credits what tax bracket you're in. All that matters is that you're a resident of this particular province, and that would generate that much tax savings. This would be a little bit different for other provinces, but in BC, this is what we would end up with. Other provinces, you would just take the lowest rate, so 5.45% in Ontario, or 11% in Manitoba, or 10% in Alberta, whatever you happen to have, and just add it in there. So now we're going to look at the actual functioning of this medical expense tax credit, what happens here. So the first thing you have to recognize is that not every dollar of medical expenses is necessarily claimable. You have to have expenses that exceed 3% of your net income for that particular year's tax return. So for example, if you earn $50,000, if you're a $50,000 income earner, then 3% of that would be $1,500. If your medical expenses didn't exceed $1,500, then you would not be able to use the medical expense tax credit in this position. Now, you can choose, we can have either spouse use them. So either spouse can claim, not both spouses though, and you can claim for one another, and you can claim for the kids as well. So you can claim for both adults in the household if there are two, and you can claim for any minor children as well. I'll talk about what happens with adult children. That's a little bit different set of considerations here. So you can claim for both spouses and for minor children who are dependent on you. That would typically be minor children who are living in the household. And we would have to look for expenses in total exceeding that $1,500 level between all three of those taxpayers. Now, the other thing that happens that makes this a little bit easier is that you can use any rolling 12-month period that ends in the year. So if we have a bunch of expenses starting in, let's say, October of a given year, you might want to wait and claim those expenses all on the following year's tax return, you say on October to October tax year. Okay, so then what else are we looking at here? Well, there's a cap to this 3% level. So if your income is over a threshold of $73,600, that's for 2015, then you're going to be at the maximum for that cap. So that's $2,208. Basically, that's the most that this 3% figure can come out to. That is, somebody who earns $100,000 would still use $2,208 as the starting point for the threshold at which they can claim medical expenses. So if, for example, we have a household where we've got spouse A and spouse B, and spouse A makes $100,000 a year, and spouse B makes, let's say, $80,000 a year. So we apply the 3% for each of them. we would have $3,000 here, and we would have $2,400 here, but actually neither of them would use that. Both of them have as their base threshold $2,208. So as long as the medical expenses in the family break through that $2,208 level, then we can start to claim. If the expenses are below that level, then maybe you wait a year and see if you exceed that over that rolling 12-month period, or if you don't break through that, you just don't get to use the medical expense tax credit. Now, in a moment, we're going to break away and look at the CRA website and develop a little bit of an understanding of what types of things can be claimed here. But before we do that, just a couple of other fine rules here is that Quebec and Ontario both have slightly different rules. The other provinces all use the same calculation as the federal calculation. But if you're in one of these two provinces, and as always, if you have a particular tax question about your situation, of course that should be handled through a competent taxation professional. But recognize that if you're in one of those two provinces, there are slightly different rules for what you can claim and the threshold that you have to get to be able to claim. So then another notable rule here is that I said we can claim over here for any 12-month rolling period, but it's actually a 24-month period in the year of death. So you may want to go back and refile tax returns for the year prior to death, and then have the ability to maybe have a larger claim associated with that year of death, because essentially now you don't have to, because we can use 24 months, you don't have to double up on that minimum threshold. You can start from an amount that's larger and only use that minimum threshold once. Then the next thing to consider is, what about if you're trying to claim for somebody other than the spouses or minor children? You can do this, but it's still limited here. So you can claim for other related people. You can claim for your parents or adult children or a sibling, for example. But basically, you have to do the calculation another time, where you have to do the 3% again, and you have to break through it for that particular individual. So we're going to have a look at a quick bit of math here to show how the medical expense tax credit will apply, and then we'll break away to the CRA website just for a couple minutes as well. So let's say that we have a taxpayer now, and this taxpayer earns, let's say, $62,000. And let's say for the period November 2014 to November 2015, for themselves, their spouse, and their minor children, this taxpayer has $3,100 of medical expenses, and these would have to be things that fit on the CRA list. Your normal set of health and dental expenses, prescription medications, some insurance premiums related to health and dental insurance. The unpaid portion, if you have insurance coverage, the unpaid portion of your insurance claims is typically going to be something you can use here as well. So this taxpayer says, okay, at $62,000 times 3%, we know that you would have to break through $1,860 of medical expenses. Now, that's clearly the case here. So we have $3,100 of actual medical expenses. We're over that threshold. So now we would have $1,240 of medical expenses that could be claimed. And let's say that this particular taxpayer happens to be a resident of Alberta. In Alberta, you would have a 25% credit, that's 15% federal, and 10% provincial, that being the lowest tax rate in Alberta. And that would give us a tax credit then of $310. Or $310 of tax savings. That's how much we knock off our tax bill. As you can see, it's not a great savings. This taxpayer ends up, just by a coincidence as to how the math works out, saving exactly 10% of their medical expenses in terms of the, or in relation to the medical expense tax credit. So now let's pop over to that CRA website and have a look at the list of medical expenses, and we'll understand how to use the list here. So as you can see, we start off with a quick Google search here, CRA medical expense tax credit. It's an easy place to go. Taxtips.ca also has a really good page on this. And we're going to pop over here and we're going to look at medical expenses. And we see the same rules we've just gone through. And what we want to look at here is which medical expenses are eligible. And we're going to see that it's quite a lengthy list done alphabetically. You can select by topic. You can try and break this down to by topic. So a lot of insurance people, for example, are going to ask about insurance premiums. And we see here the note about premiums paid to private health services plans. Essentially, if you're paying premiums for a plan that's going to cover the things that are on this list, those premiums are going to qualify for the medical expense tax credit. Now, we have lots of different choices on here. So some things like moving expenses that you might not have considered. For example, moving expenses if you have to move to be closer to a loved one who's receiving medical care. Now, an area that a lot of people ask about would be, let's say, medical expenses provided by qualified medical practitioners. So we can pop in here and we can see that we have a list here, a separate list for medical practitioners, and we can go in here, and being an Alberta resident, there's something on here that always strikes me as unfortunate, and we can see, for example, depending on the type of medical service that you're getting, it may or may not be approved for the province that you're in. So an example of this would be, if we look at massage in the province of Alberta, for example, we see registered massage therapist, and we can see that Alberta in particular, the province in which I happen to reside, does not approve services for massage therapy, and this would stand to how the professional licensing body in that province does this. We see, in fact, most provinces massage therapy would not be covered under the medical expense tax credit. And the challenge with this, of course, is that that also means that you can't typically use a health insurance plan to cover that. Generally, health insurance plans are only going to cover items that show up on this list. So thank you very much for following along with me. I hope that's been a useful introduction to the medical expense tax credit. You can see that it's a fairly tough to use credit in practice. I wish it were easier. I wish that we could claim it from maybe the first dollar of medical expenses, but it's not so. So it is important to understand it because of its particular limitations, and because we see that a little bit of planning here can maybe open up some opportunities that we would not have otherwise considered. Thank you very kindly, and I hope you enjoy your continued studies. Hi, and welcome back to the Business Career College video series. In this video, we're going to look at private health services plans, PHSPs. It's not a term that you run into much in practice. What you'll more often see in practice is the health spending account or healthcare spending account. And these are essentially just practical ways of implementing a PHSP on or sometimes you'll see a cost plus arrangement. So these are all various arrangements that use the PHSP rules or healthcare spending account. Now, the PHSP rules are actually designed originally to take care of this situation where we have an employer. So this is the rules in their base form. The employer pays premiums for a health insurance plan for an employee, and then the employee uses those benefits tax-free. So it's a tax-free benefit. Both the premium and the actual reimbursement of expenses are tax-free to the employee, and this makes this a very attractive benefit, and it's why we see this so often, not just the appeal of it from a practical perspective, but the tax appeal is also fantastic with this because it lets the employer deduct these premiums while passing on a benefit to the employee that is not taxable either when the premium is paid or when the benefit is received. Now, that's not really what we want to focus on here. We want to focus on these other variations on this, the healthcare spending account, health spending account, or cost plus arrangement. So what we see here is a variety of concepts, but they're all going to look roughly similar in the sense that now instead of using a health insurance plan, the employer is going to set aside, and we'll use an ER for employer and EE for employee from here on, the employer sets aside or budgets for a certain amount of claims. And then the employee can draw on that budget. And the rule here would basically hold that it would have to be something that fits into the medical expense tax credit. We do have another video that covers the medical expense tax credit. And as long as we meet all of these criteria, METC there is medical expense tax credit, as long as we meet all of these criteria, then we have the same treatment where the employer gets to deduct this and the employee has this as a tax-free benefit. So in a health spending account, we're typically going to see the employer say, we're going to set aside $500 or $1,000 or $2,000 or whatever it is. In a healthcare spending account, the same type of arrangement. Cost plus is essentially an after-the-fact arrangement where the employer says, oh, you have a cost of $500. We're going to now cover that off, plus a little bit of an administrative cost that an insurer normally assesses there. So this can work out very well, but we get ourselves into some problems here, especially in smaller businesses. So in a big business, in a big incorporated business, this is not going to be much of a problem. We basically will see all of this done on an arm's length arrangement. And as soon as it's arm's length, then it's very unlikely that you have what might be considered an unreasonable benefit. Essentially, we say, you know what, if you're making $300,000 a year, maybe a $30,000 health spending account is not unreasonable. That might be what it requires to retain that particular employee. So what we can do here is we say, all right, now I'm self-employed. So can a self-employed person use the health spending account? They can, however, there are some restrictions here. So a self-employed person, they could go out and buy a plan of insurance, but if they're going to use one of these other arrangements, this health spending account or cost plus arrangement, then the limit here is $1,500 per adult in this self-employed person's household and $750 per child. And it's not that the limits are ascribed to those particular people, so it's not that you can have $1,500 of claims for that adult, but rather what this would mean in a household with, let's say, 2 adults and 2 minor children, your total limit for what you could do this year would be 1,500 times 2 here and 750 times 2 here. So we would have $3,000 for the adults plus another $1,500 for the children. So in total, this self-employed person could have up to $4,500 of costs associated with a health spending account or a cost plus arrangement, and it could be for any of that group of people. Now, this gets a little bit more complicated when we are incorporated. So it's easy enough when we're dealing with an arm's length party, but it gets more complicated when we have a smaller business and we're dealing with the shareholder now. So we're going to look at two different types of scenarios. In our first scenario, we're going to have a shareholder who has employees. So can this shareholder use a health spending account for themselves? And they can, but we have reasonableness limits here. So the reasonableness limits say you can use this, but only to the extent that you would have used this for an employee in the same position. So if you're paying yourself an exorbitant amount of benefits here, that's where we end up with a problem. And a good example of this is a case called Spicy Sports v. the Queen, in which an owner of a small ski shop in Whistler, British Columbia, tried to run $43,000 of medical expenses through the cost plus plan, and it was seen to be far in excess of what he would have allowed an employee in the same position to do. So when we violate this reasonableness, and the problem here is reasonableness is a question of fact. It's not something where we can firmly establish what's reasonable in each circumstance based on some formula. Instead, we have to say, hey, if you were an employer hiring this person and you're paying them X number of dollars of salary, what would be an appropriate amount of health benefit to also offer that person? And that's where we would arrive at a reasonableness test. So this reasonableness issue then, what's going to happen here is we say, okay, what would you have offered to an employee? And if you exceed that, then we end up with a shareholder benefit, which means it's not deductible to the corporation and taxable to the shareholder as regular income. So we want to be very cautious of that. And that's where, as with any of these issues, we want to make sure we're getting good advice from a tax accountant or a tax professional who understands the taxation of this. Now, what if you're incorporated and you have no employees? Well, this is where we have a little bit of a problem. There is actually a technical interpretation from Canada Revenue Agency. If you want the technical interpretation number, it's Technical Interpretation 2014 05213 01 E5. And it says, no, you can't. Now, it does qualify that a little bit and say that there may be circumstances under which you can, but the surface here, the surface level says that if you're incorporated with no employees, that you cannot use a cost plus or a health spending account type of arrangement. Now, I'm aware that this is quite common in practice and that CRA hasn't been in the habit of challenging this, but I would be very cautious before implementing this in an incorporated business with no employees. So CRA's position is no, this is not allowed, but as stated, there are definitely some qualifying factors there, and one of the things that CRA technical interpretation says is if you can show that another business in the same capacity would offer this benefit to an employee, then maybe it's okay to do this. So unfortunately, as with so much of the Income Tax Act, we have a huge amount of gray area here. If I were doing this myself, I would want to watch and see first off that we're not doing this only for tax reasons. I would say, you know what, would we do this if we had employees? And I might apply the reasonableness test over here based on the $1,500 and $750 that we see. I'm not suggesting that as tax advice. I'm saying if I were doing that myself, certainly every position is different and you do have to be very cautious of this. So I would not implement one of these in a incorporated business with no employees other than the shareholder unless you get very good tax advice and you're fully aware of the risks of doing this. So I hope that helps to understand the private health services plans arrangements, and I hope that you see how to use these in your practice and that you enjoy your continued studies. Thank you very much.